Every big move starts the same way, a liquidity sweep followed by a reaction from a fair value gap. It's not random, it's calculated. In this video, I will break down how smart money uses these two tools to track retail traders and deliver precision entries. So without further ado, let's dive in straight. Alright, so these are the two trending structures that we have in the markets. Now we have the bullish structure and we have the bearish structure. Now starting with the bullish structure, we have price created a break-off structure at this very level. Now after we had that very break-off structure, what actually caused the break-off structure was this demand zone that was forming around this very level, which pushed price further down, causing this very break-off structure. Then after we had that break-off structure, we have this FVG level, this fair value gap that was forming at that very point. Now mostly what price does is that whenever you tend to be interested at this very demand level, price doesn't tend to make it at this very demand level. What price does is to come straight to the FG level, starts to keep pushing towards the upside. So now basically what I want to be doing is to be looking out for liquidities staying around those very levels, either on the FVG levels or on the demand level. So at this point, basically what we are having is that we have price forming a liquidity, building a liquidity around this very level. I think that you understand that whenever we see price building a liquidity around an FVG level or even around the demand level, we should expect what is liquidity sweep to that very level, then coming at that very FVG level for us to buy. I don't know if you guys understand. So at this point, we had a liquidity that was building around this very FVG level. So what are we expecting? We are expecting that if we are going to be interested to buy around this very zone, we should be interested on this FVG level, since price is building liquidities around there. So therefore, I want to be expecting price to come take out that very liquidity that is building around there, then tap on that FVG level, that fair value gap, for us to buy. That's basically how it works. And for the bearish structure, we had price created a break-off structure below. We had a break-off structure at this very level. And after we had that break-off structure, we had the supply zone that created that move, the overall move towards the downside. And after we saw that move towards the downside, we had an FVG level that was forming around this very point. And basically what I'm expecting price to do is, once we have already seen that price is actually building a liquidity around that very FVG level, what I'm expecting price to do is to come take us that very point of liquidity, tap on the FVG level for us to sell. I don't know if you guys understand. That is how it works. You don't expect price to build a liquidity around this particular FVG level, expecting price to come at this very supply zone, because it's obvious that this very FVG level is the level that is going to hold, because that is the valid point where we are expecting price to come so we could sell to the downside. That is basically how it works. I'm going to be moving you guys to the chart, and I'm going to be breaking down step by step how these things work and how to trade them. So this is basically how a bullish structure should look like on the chart. Now what do we have? We have price created a little break-off structure at this very level. Now what created the break-off structure was this demand zone. After we saw that last bearish candle formed, we had the next bullish candle push aggressively, causing this very break-off structure. That's what price was doing at that point. We have that FVG level that was formed at around that level of break. Now what do we expect? We expect that if we are going to be interested to either buy and any of these zones, either the demand level or even on the FVG level, we must see a liquidity. Now where was the liquidity building? We had this liquidity building at this very level, which means that if this liquidity is building around this very level, we should be expecting that price should come tap out on this very FVG level for us to buy. It's as simple as it is. We have the liquidity building around that very FVG level, so we should be expecting that price should take out this very level, this very liquidity that is building around this point, then tap on this very FVG level, this very fair value gap, for us to buy. So if I want to be interested to buy, I want to be interested to buy at this very level. After I must have seen this very liquidity zone taken out, I want to be interested to buy at this point. My SL should be above the very candle, that very candle that created the FVG level, which is this very point. So my SL should be around that very level, and my TP should be above at least 1 to 2 weeks to reward, or even 1 to 3 weeks to reward. We also had another level at this very level. This one is more of like a different one. We had, first of all, we had the FV level that formed, and we had a liquidity which was building around that very level. Actually, we had a little minor break of structure. So now basically what we expect price to do is to come take out this liquidity point which has been built, expecting price to come tap on this very FVG level for us to buy. It's as simple as it is. When we've already found out that there is a liquidity grab around this very level, and we are seeing that there's an FVG level around this point, we want to be interested to wait for price to take out that very liquidity zone, come on that FVG level for us to buy. So at this point, if I want to be interested to buy, I want to be interested to buy at this very level. My FX should be at this very candle that created that FVG level. Then my TP should be above at least 1 to 2 weeks to reward, or even 1 to 3 weeks to reward. And as soon as price keep pushing towards the upside, you have those levels forming. We had a break of structure, and what caused that break of structure was this demand zone around this very level. And after we had that break of structure, we had a fair value gap that was formed at that very break of structure. So basically what I want to be doing is to be looking out for a liquidity around that point. If I'm going to be interested to take trade on this FVG level, I'm going to be expecting price to build liquidity around that very zone. But if price is not building liquidity around that very FVG level, I should be expecting price to come at this very level, at this very demand zone for me to buy. If there's also another liquidity building around that very demand level. I don't know if you guys understand. So at this juncture, we had price building liquidity around that very FVG level. So basically what I want to be doing is to be waiting for price to take out this very level of liquidity, tag us in on this very FVG level for us to buy. So if I want to be interested to buy, I want to be interested to buy at this level. My SS should be below the candlestick pattern that formed, and my TP should be above. So that's basically how to trade the FVG level with the liquidity sweep. If you want to be getting a higher win rate, you want to be combining the liquidity graph with the FVG level to get a clean entry. So I'm going to be moving you guys to the bearish structure, and I'm going to be breaking down how the bearish structure moves. This is for the bearish structure. Now what do we have? We had a break of structure to the downside around this very level. Now what caused that break of structure was this very level of supply, which pushed price aggressively to the downside, breaking this very level. Now after we had that break of structure, we had an FVG level that was formed around that very level. Now basically what I want price to do is to build liquidity around that FVG level. If I must be interested to sell around the FVG level, I want to be seeing a liquidity that is building around that FVG level for me to sell. Now basically we had the liquidity which was building around that very zone. All I want price to do is to come out, take out this very liquidity zone, tap in on that very FVG level for us to sell. Because most times when you expect price to just take out this liquidity, come at this very supply for you to sell, you might miss out. So this is the zone which you're supposed to be looking at for. Since price is actually building liquidity around that very FVG level, we should be expecting to take our sell around the FVG level. So if I want to be interested to sell at this point, I want to be interested to sell around this very level. After I must have seen this liquidity zone taken out, I want to be interested to sell at this point. Then my SS should be above that very candle, and my TP should be below. It's as simple as it is. And as soon as price keep pushing towards the downside, we had another break of structure. We also had another FVG level that was forming around that very level. And looking at what price did, we had a liquidity that was building around that very FVG level. So what I want price to do is to come take out that very level of liquidity, tag us in on this very FVG level for us to sell. It's as simple as it is. You want to be looking out for liquidity zones building around that fair value gap for you to be interested to sell. So if I want to be interested, I want to be interested to sell at this very level. After I must have seen price takes out this very liquidity zone, I want to be interested to sell at this point. My SS should be above that candle that formed that FVG level, and my TP should be below that zone, at least 1 to 2 or even 1 to 3 weeks to reward. And that is how to trade the fair value gap and liquidity with respect to the bearish structure. So if you found this video helpful, don't forget to like, subscribe, and also turn on the notification bell so you don't miss out on any of my trading insights. Alright, thank you and see you on my next video.